Welcome to Human Risk, a podcast dedicated to the understanding of human behaviour as a risk. Here's your host, Christian Hunt.
Hello and welcome back to the Human Risk podcast. In this series, I speak to people that can help us to understand the drivers of human decision making and what we can do to influence them. And if you were looking for a sector that contained plenty of examples of human risk, then you'd probably pick the banking sector. It's the industry I've spent most of my career in and that has formed the basis of my whole human risk mission. In a previous life, I was a banking regulator, which is where I worked with my guest on this episode. John Sutherland is a banking expert and a senior advisor to one of the UK's financial services regulators. And he's just written a book that was inspired by the work that he did for a UK Parliamentary Commission, looking at what had gone wrong in the banking industry. And one of the key questions people understandably ask of the industry and its regulators is why more wasn't done within firms to prevent some of the poor behaviour and decision making that we've seen. Now, one of the ways that we try to mitigate risk, and in particular human risk within organisations, is to have independent oversight. And boards in the UK, including banks, are required to have non-executives, independent people whose role is to keep the executives in check and ensure the company's appropriately managed. But given the complexity and scale of many modern banks and other organisations, how is a non-executive expected to keep a handle on what's going on within the firm? After all, if you're only part-time and not involved, how can you possibly know what's going on? It's an interesting question that applies to all companies. And if we're going to rely on non-execs as part of the means of ensuring companies are under appropriate control, then it's reasonable to expect them to know what's going on. It's a question John set out to explore in his book, Ensuring General Wisdom, which explores the importance of non-executives and trustees in corporate governance and how we need to learn from past mistakes. Now, if you thought books on governance were dull, think again. This is a fascinating review of where things have gone wrong in big companies and organisations and how non-executives could have helped prevent them from happening again. John is not only a formidable thinker who brings his on-the-ground experience to banking in fascinating ways, he's also a lot of fun. So please enjoy my conversation with John Sutherland on human risk at a board level and what we can do about mitigating it. John, welcome to the Human Risk Podcast.
Thanks very much for asking me to come on, Christian. Really appreciate it.
It's an absolute pleasure to have you here. Now, you and I go back some way, so I know who you are, obviously, but my listeners might not. So can you just give us a little bit of a sense of you and your background?
So 46 years in the industry, started off chapter one, left school, Lloyds Bank for 14 years, all of the apprentice stuff you do in branches, and finished up as a payment specialist. I was recruited by Nationwide for that specialism because they just launched a current account. I was there for 20 odd, very happy years, left as sales and marketing director and wound up as a regulator for 10 years at the Bank of England, the FCA and the FSA. So I've been gamekeeper and I've been poacher, or perhaps it's poacher and then gamekeeper. So that's where I am. And it's been great. I've had a fantastic time.
It's amazing. And, when I talk to people about outside the industry about banking, the first sort of reaction is it sounds a bit dull. But you can just tell from speaking to you that there is a certain sort of passion for the industry. And you've kind of been on the ground in the good old days when we always used to go into branches. And you've sort of seen quite a lot of transition in that space. So I'm intrigued, one, what drives your passion and interest in the industry? And then secondly, your thoughts about, the transition that we've seen in that space and we are seeing.
Well, I mean, banking, like virtually every other sector, it's a people industry. And one of the things you do appreciate is that when banks and building societies and credit unions, for that matter, get it right, they're able to improve people's lives, whether it's a family or whether it's a business. I mean, in my early years at Lloyds, many years ago, I saw the impact a really good branch manager could have on local businesses. And it was phenomenal. People thrived because of that man's enthusiasm and passion for helping them with not only finance, but also sound advice. So it's that kind of thing, to be honest. And the transition or the transformation, as you say, yes, I mean, back in the day, when people talked about church spire lending, the joke was if you couldn't see the business on the top of the church spire, you wouldn't do business with them. And that was largely because all of your intelligence was local and it was word of mouth. Of course, these days, the data that's available is absolutely phenomenal. And what we've discovered out of COVID, of course, is that you can do business around the world. So I can very easily join a conference in the US, whereas previously it would have taken me 3 days flying in and out of the US to do that. And that goes for engaging with businesses around the world. So it's been remarkable, the change that's happened.
Implicit in what you're saying when you describe the sort of purpose of banking, if you like, is this kind of social good. You know, there's a pro-social purpose to doing lending. And so this traditional idea, I remember my dad saying, you know, you couldn't go and get married without talking to your bank manager, because that was in essence something that was relevant to have them involved with, because that was making commitments and things. So you need to make sure they were okay with that happening. Now, I'm sure that's a sort of slightly exaggerated story, but nonetheless, the point remains that banks were kind of at the heart of communities, and we allowed them to have licenses to sort of fulfill that purpose. And they were there and accepted as part of the community because they were adding value. And then over time, we've sort of seen that slowly erode with, what is critically called casino banking and some of these other things that are less obviously socially useful. And I'm intrigued by your thoughts on that transition and what we've seen happening there, and possibly a backlash against that at the moment.
Well, I mean, I'm open to immediate criticism on the subject of bankers, which is the general perception is that they're not great people. And I mean, a lot of that has come out clearly of the 2007, 2008 episode, which then led to all kinds of austerity agendas. It has changed enormously, because you make a joke about getting married, but it was only 2 years before I joined Lloyds Bank that the bank stopped telling male members of staff they had to ask their manager's permission before they got married. And that is a true story. Right. So it was a very much more paternalistic environment. And it was very much couched on you were paid a salary as a manager, you were not bonused on sales. And certainly that is part of the culture that has changed. So incentives are a big deal in terms of any industry. And it's not just financial incentives. Obviously, the big non-financial incentive is recognition. And who you recognise and who you don't recognise makes a big, big difference to your workforce. And these kind of things, it's not just banking. These apply outside of the banking sector. They apply everywhere. But absolutely, the biggest change has been in the, if you like, the financial environment that surrounds management, which used to be salary for life, and now is very much a bonus packaged, incentivized approach. That's not the only reason I think that things have changed, but that is definitely one of them.
There's also been a huge amount of consolidation in the sector. So we had a lot of, if I think in the UK, we had a lot of local building societies that all merged and were subsumed into one. So there's a lot of losing that sense of connectivity with, quote unquote, the real world. And I wonder, your thoughts on that. I mean, it's obviously there's a natural evolution, particularly as we've gone online, but it was happening well before then, that this sense of a business that's here to serve the local community somehow started to get disconnected as we saw some of these sort of monoliths taking over. And that idea of everybody who knew who their bank manager was because they were local to them and would understand the local environment, that's been lost quite a lot in some of these trends.
Well, I mean, one thing that has changed is the length of time that people will be a manager in a particular area. Now, we are moving into a world that is less face-to-face and more online. But when I was back in the Nationwide days, when I was running Nationwide's branch network, the absolute best branch managers, or in the top, if you like, 10% of branch managers, would be job shares. They were phenomenal combinations when you got it right. And apart from anything else, they weren't anxious to move on to the next job, because chances are those job shares were sort of second salaries in the family. And that meant that you had a longer timeline in that town or that village. And this is what you had back in the day. And what customers value is stability, and they want a relationship. But of course, we're now into a world where people are so used to having the relationships through the screen on the phone or the screen on Zoom or WebEx or whatever it might be, that's changed anyway. And I'm not hankering back to it. I'm simply saying it's different and life has moved on.
Yeah, I mean, you're sort of talking around the way people thought about their careers and the way, I guess, they thought about their employer and the loyalty to that employer and the relationship they had, and the fact that you're probably incentivized much more to think about the long-term stability of your employer in a way that if you're bonused, you're thinking about your own short-term gains. And we've seen a lot of the impact of that sort of remuneration and that sort of thinking on the way people behave in the industry. Do you think, I mean, you talked about the impact of kind of compensation and what that incentivization rather than what that drives people to do. Do you think there's a sense now that we are sort of starting to return to some of those traditional ways of thinking, that we have to much more align the employer with the employee?
I think people have realised that if you're working in an organisation, you want to have some emotional connection to it. People are far happier if they have a purpose in going into work. If you sort of get out of bed in the morning with a spring in your step because you're looking forward to going to work, that's a completely different game to you are getting up because you have to go in because you need some money and you're not at all connected with what it is that you're doing. But yes, I mean, back in the day, you were in a job for life largely, and it wasn't just banking; it was anywhere, whether it was teaching or manufacturing or whatever it was. And so that changed over time, where people are much more likely now to job hop between organisations, and are much more likely to have several employers, or if not many employers, during their lifetime. And that, I think, that makes a big difference. You want fresh minds coming into organisations. I'm a huge fan of that. But it does make a difference in terms of people's outlook. If you have got a more steady view on where you're going to be, you've got a more steady view on how that business is going to work. I guess there are pluses and minuses to it, though, Christian.
And the area that you've sort of specialised in quite heavily is the area of governance and controls around things. And you know, coming out of your experience has been a real focus on this idea of having non-executives and how they operate and the control that they exercise on the business. And it's something I just want to pick up. But before we look at the detail of that, can you just give sort of my listeners in countries that might not sort of understand what a non-exec is, a little bit of a sense of what do we mean by non-executive? What are they there for?
Well, in the UK, we have what are called unitary boards. And on a unitary board, you have executive directors who are full-time and salaried, and the most senior one is the chief executive. And you have non-executives who are paid an annual fee, and they're part-time, typically 30, 40, 50 days a year. And the most senior non-exec is the chair of the board. That is the UK model. Slightly different model in some parts of Europe, where you've got a two-tier board where the execs are on a management board and the non-execs on a supervisory board. But the non-executive's role, to my mind, is to be there to give challenge and support to the executives. So they tend to be older with longer career histories. And because we're back to the incentive point, they're independent-minded in the sense that they are not incentivized to develop the business, because you want somebody to say, hang on a minute, you're rushing off over here, but actually I think it would be better if we just slowed this down a little bit. Whereas if you knew that your incentives and your pay was bound up on going over there, that independent challenge which you need might not be there. So it's a really important role, in my view, really important.
And it's a very interesting example of a sort of a traditional structure that's clearly been put in place because we recognize the dynamics you're talking about. So when this idea was originally floated, when it became part of, I guess, both business practice, but also legal and regulatory requirement that these people existed, there's a very clear acceptance that people, if you don't keep people in check, they will do interesting things. And one of the best ways to keep people in check is to have some people that have a different kind of skin in the game that can present a different perspective. So in many respects, it's beautifully identifying the benefits of diversity. It's beautifully identifying the benefits of, ensuring that we sort of calibrate people, that we make sure that all of our, well-intentioned incentives for the executives in the business can produce side effects. And so we need some people to call that out. So it's at its basic level, it's a very intelligent way of thinking about things, recognizing what I would loosely call human risk can exist.
Yes, no, I think that's right. And I think it's not just about keeping people in check. I mean, that can be very important, but it's also about this providing advice and the diversity of thinking. And you on a let's say a bank board, it would be a pretty big disaster in my view if all the non-execs or ex-bankers. You do want one or two who understand how a bank works, but you get the opportunity to bring people in from different sectors with a different perspective. And that is very important, which you've got the luxury of doing because you've got these non-execs on the board. I think the worst place you can be is if you have, or a bad place is if you have no non-execs on a bank board who are ex-bankers. But this applies in aerospace or in airlines or hotels. You need a couple of the non-execs who understand the sector so that they've got the sector knowledge. Otherwise, the execs are constantly at an advantage and the non-execs are constantly on the back foot because they don't really understand the sector and how the dynamics of the business model work.
And that's a really interesting point, isn't it? Because there's been a lot of people that sort of, if you look at structures of certain companies where it's kind of like, who are the non-execs here? Well, the answer is the former execs. So they've just sort of moved upstairs. And the idea that they, so there's a logic to it which says, who knows the business better than the people that have lived it? On the other hand, there's that keyword of independence and sort of coming and bringing, and it's very difficult for you to sort of challenge things that you might have experienced in the past yourself, or, been part of creating. So, I can see the value and I can see the logic that gets people there. But it's also very, very dangerous if it's literally a retirement home for those that were once running the company.
Well, that's true. I mean, you mentioned building societies earlier, and I've got a long history with the building society sector. There are just over 40-odd building societies left, the very huge nationwide through to some very small ones. It's not unknown. In fact, it's quite a regular occurrence for a CEO of a building society to retire and to become the non-exec of a building society, but it will be a different building society. It won't be the one that he or she was CEO of. I mean, that is pretty much a disaster. Who wants to be the CEO of an organization and the ex-CEO is on your own board? I mean, that doesn't even feel like a good human dynamic, does it? I wouldn't want that at all. So no, I think it's absolutely fascinating. I think the chair's job is equally fascinating because you have to bring this small group of people together. People talk about corporate governance, Christian, but I prefer to call it corporate leadership. And the chair's job is to bring this little group of execs and little group of non-execs together and get them to work as a team for the benefit of the organization and therefore the customers, the employees, the suppliers, and the community and the environment in which we live. And it's getting that to work. And that's not a trivial job at all.
Clearly, I know the answer to this question, but I think it's just worth exploring because I have some listeners in jurisdictions, notably the US, where you're allowed to combine this chairman and CEO into one person. Now, I have never understood that because by dint of the fact that there are two separate job titles, sort of suggests to you that they might be two separate roles. I mean, it seems to me it's a massive conflict of interest.
Well, when I do a ton of lecturing and consulting and speaking on this subject, and I use the example of three different sorts of boards. So there's a UK unitary board we've spoken about where the chair and the CEO are different people. There's the, if you like, called the European two-tier board where you've got a chair of the execs and a chair of the non-execs. And you've got what I call the US presidential board, which is, as you describe, one person is the CEO, the president, and the chair, and that person recruits the non-execs. And I'll say in a lecture, to undergrads or MBA students, which of these do you think is the weakest? And everybody always says the US board. And then you have to say, well, okay, so what about Intel and Apple and Walmart? And you can run through Texaco, and you can run through any amount of global US firms that have been hugely successful. And what this has always told me is there are two dynamics to this corporate leadership. One is the design. So is it unitary board, presidential board, two-tier board? And the other is effectiveness. And it's effectiveness that's the most important thing of all. So you can't ignore the design. But I think effectiveness is to design as 80 is to 20. So you can make any design work, and this is back to the role of the chair. By the same token, nobody ever says that the UK unitary board is not the sort of that is not the weakest of the three. And if you talk about banks, you'd say, well, that's a little bit unfortunate because let's just imagine RBS, HBOS. So you see the point. It's not about design, and it's exactly the same in the NHS for hospital trusts, because all the hospital trusts are unitary boards, and yet we've seen terrible failures in places like Midstaffs and Morecambe Bay, and huge successes all over the NHS. So they're very much outliers. But nonetheless, it's not the structure of the board that's the point. It's the relationship between the chair and the CEO and the people on the board. Are they an effective team together? That's what it boils down to.
And it's a really interesting point, actually, because it's illustrative of an approach that we often see to controlling human behavior. And in this case, you're looking sort of from a risk management perspective. But we create these theoretical models to say, this is how we will get people to behave in a certain way. And we spend ages designing these things. And, my listeners who are auditors are not going to thank me, but I often see auditors doing this, coming up with what I call theoretically perfect, but practically flawed solutions, where you sort of go, that looks great on a piece of paper. But as you say, it all comes down to what does actually happens on the ground. And if you've got people that take it and play with it in the right way and adapt accordingly and use it intelligently, you're right. You can compensate for weaknesses in design through amazing execution. You can also destroy incredibly well-designed structures that look theoretically perfect if you behave in particular manners. And so I think it's a really interesting insight into the sort of how do people behave? Well, the answer is not in the theoretical way you might like them to.
That's very true. That is absolutely true. It's a bit like the criticism you hear for 3 lines of defence, which you get all the time. So if you're in financial services, you know all about 3 lines of defence. Maybe not so much outside. So let me just describe it. The first line is the business. The first line is earning the income, marketing the products, planning the business strategically, deciding what to do. It's the front end of the business. Second line, Christian, is what you talk around a lot, which is risk and compliance. And the third line is internal audit. And people rail against this hopeless structure that causes all this bureaucracy and poor behavior. But actually what they're talking about is ineffective implementation. It's about the effectiveness of people. So it's not just the preserve of the board. I think the 3 lines of defence is a reasonable design, to be perfectly honest. But how you implement it, if you wind it with 3 silos that don't talk to each other, then you've got a recipe for disaster. And it wouldn't matter how you designed it, you'd have a problem.
I love that. And thank you for explaining it nicely and succinctly. I was thinking I'll have to jump in and explain what that is for my listeners, but you've done a far better job than I would ever have done. So thank you for that. We'll put links to details on that in the show notes for those people that aren't aware and are fascinated to find out more. But I want to come on, John, and talk about your book, because I think it starts from a lovely sort of simple bit. And I love reading introductions to books that sort of go, here's why I decided to write this. And I think you've got a really nice story about a question, as a discussion you had that has prompted you to write this book. And I'd love to sort of explore that and then come on to talk about what's in it.
Yeah. Okay. Right. Well, I was very lucky to have been seconded onto the Parliamentary Commission on Banking Standards back in 2012. I was on the support team. I wasn't on the commission, I hasten to add.
So this, for overseas listeners, is basically the part. So UK Parliament decides it needs to take a good look at banking and what went wrong in the sector. And so you're brought in as an independent expert. And the idea being this will inform legislation that will then inform regulation and then basically sort out the issues that went wrong in the sector before.
Absolutely right. So it involved a lot of bankers and non-bankers giving oral and verbal evidence to the Commission. And I was on the support team to help that happen. And I got into a conversation with a non-exec, and I ventured to suggest that one of the problems that had gone wrong was that non-execs hadn't been as involved as they should have been. Whereupon I am lectured to within an inch of my life and told it is impossible for non-executive directors in a modern large bank to know what's going on. And I just said, well, that can't be true. Have you considered that perhaps then you need to give more time to it? Of course, that didn't go down well. So then I suggested maybe the bank had just got too big and it needed to be split up. And that went down even less well. So in the end, I said, well, we'll just continue pretending then. Let's just pretend everything's okay. And that's what then sent me off on a journey to find out what the role of the non-exec is. That's what really sparked it. I thought, it cannot be the case that non-execs do not know what's going on in a large and complex organisation. Otherwise, the whole design that we've been talking about previously is rubbish and it doesn't work. And the more you did the research, the more you realised, actually, it's perfectly possible for non-execs to know what's going on. But the same things keep going wrong again and again and again. And that's the interesting takeaway from this. It's the human nature thing. We never seem to learn from history.
And I find that I can see why you were, I'll put words in your mouth, sort of enraged slightly or surprised by this response, because you sort of look at it and go, well, if they don't know what's going on, then what is the point in having them? And I'm guessing here, and you don't necessarily need to answer this, but I'm guessing the individual concerned was one themselves. And therefore, but I'd look at it and sort of say, that is the kind of excuse that sort of, well, yes, it happened on my watch, but how could you possibly expect me to know this? To which my counter argument is always, if you are taking a paycheck, and these things are not badly remunerated, although sometimes they're out of whack with the risk you're actually taking. But I look at it and sort of think, if that's your job, then you can't really use the excuse of it was a bit complicated and difficult, because that either suggests that you haven't got to grips with the job, or you're not taking the job seriously, or you're not, you're probably not the right person for it. So I find it it's a natural human thing to say, well, the reason, it's almost like sort of, well, when it goes wrong, I couldn't possibly have known. Well, why are we paying you to sit here?
No, I think that's true. You're trapped whichever way you look at it, because if you're truly accountable and something goes wrong and you didn't know about it, then probably you should have known about it. And I know there's this, well, how can the CEO or the chair of the board know something that goes wrong in the guts of the organisation? The odd bit and piece of things that go wrong, of course you can't. But if you've got a whole, these were banks that collapsed. And in fact, the Commission had been set up because of the LIBOR rate rigging problem. And that's a whole cultural piece about why did people think culturally it was fine to do that. And that culture is absolutely at the door of the board. But I don't think it had previously been thought of in that way. Whereas now, I think we all take it for granted. It's back to your earlier point. I mean, what brings people into work is that there's a purpose in the work that you do. And I think it's important to try and get that kind of culture to work, because what you don't want is a bullying and intimidating culture. And that is the truth, yeah.
And it's almost astonishing that you sort of that these constructs, and we've allowed this narrative to continue for some time, which is sort of one of, large organisations are there, and people in senior positions don't think of it as their responsibility to know what's going on. I'm here to lead and do, but I can't really get involved in the minutiae. And there is almost this sort of view that anything, I'm not, I'm interested in big picture things. I don't need small things. And then, as you say, very often in organizations, it can be a small thing that brings an organization down, but it's got to be a small thing that's got bigger. And therefore, we look back at these things with hindsight and say, actually, if you'd asked the right questions or you'd had the right straight, you would have found this out. And yet you didn't do that. And there's plenty of, as you say, that we rewrite history time and time again with the same narratives, where if I look back at something, there are companies like Enron, and you can see that repeated through in certain other organizations. You've got what happened in VW. There are lots of, even if the industry is slightly different, the theme remains the same, which is this sort of lack of control as to what's going on. And yet there were lots of things in place that suggested that control did exist.
Yes. I mean, I should say that and I've spoken to many non-execs after that first conversation, and that first conversation was an outlier, because most non-execs really do get this stuff. But you always know when you're up against a non-exec who doesn't, because you ask them what their job is and they'll talk about strategy. Now, it's in the Code of Corporate Governance. You're there to help the CEO and the executives develop the strategy. Of course you are. But you're also there to help them understand how the business works, and you can't shirk that responsibility. I'm old enough to remember an acronym called MWBA, which stood for Management by Wandering About, and that came from Hewlett Packard. Literally Mr. Hewlett and Mr. Packard, and it's about getting out to the front end of the business. And that's part of the non-executive role as well. And it's not about royal visits. I mean, if I learned many, many things from running Nationwide's branch network. It was one of the most phenomenal jobs I ever had. But one of the things I learned was never to let the area managers know which branches I was going to visit. Because much as I love my area managers, and I genuinely did, they were a fantastic troop of folks, I needed to go and see what it was really like in the branch. I didn't need to go to a branch and discover it packed with dark blue uniforms and smelling of new paint. So that's what you need to sort of be able to do. And you can't do it very often. You've got other stuff to do, but you have to be able to get out to the business and sort of take the temperature. And if you're simply relying on people bringing their papers into the boardroom and having board lunches with execs, you're not really getting at the heart of this organisation. And the really good CEOs get this as well, because they want their non-execs to go out, because they want them to bring the stories back. So they're like eyes and ears.
And I love this idea of the information that flows into the boardroom being heavily filtered, because it is created by the people you are overseeing. And so by default, now that's, I'm not suggesting that every single board report is full of cover-ups, but there is a way of presenting information that sort of tells a story in a particular way. And actually, as you rightly point out as well, with the sort of customer visit angle, is you can think your organization's running brilliantly because in theory you've got a great customer service, great proposition, and actually if the customer's not finding it the way you think it ought to be, then your business is screwed, because the customer will vote with their feet and go somewhere else. So I love this idea of sort of calibrating those two things by saying, okay, I'll take the information that's given to me, because to your earlier point, I can't dig down and read every single micro report that's ever produced within the organization. And there's a little bit of danger. It needs to be distilled to me to arrive. Otherwise, my board papers will be extraordinarily big and therefore, again, hide things in there that I might not. So I need to calibrate these two particular pieces. And the way I calibrate that thing is to go out and say, let's have a look and see what it's like from the ground. Yeah. And I love this idea of people doing, there's some great TV shows. I think Undercover Boss is one of them I really like watching, where the boss goes, and of course, because it's TV, they discover shocking things going on that I always think they could have worked out if they'd had the right processes internally. But nonetheless, it makes a really good point. If you need to calibrate this thing with the information you're given is by its nature filtered, and therefore actually you're going to need to find other ways to get the information you need to do your job.
Yeah. I think people overlook the fact that upward communication from the ground floor to the top is way more difficult than downward communication. But organizations invest a huge amount of money in downward communication and very little in upward communication. So there's this great work that's been done by Amy Edmondson at Harvard called about psychological safety. So if I speak up to a very senior person when that very senior person comes to visit, what happens to me after the very senior person's left the room? Do I then get chastised by my manager, or does it get taken out in a more passive-aggressive way in 2 months' time when my performance review comes up? And the upward communication side is where the investment has to take place. And the reason I mention it is because the flow of information onto the boardroom table is very largely controlled by the CEO. The chair will definitely say, I want this on the agenda, but then the paper's going to be written by the executives and brought in by the executives. And so you have two concerns. One is that they're not telling you everything. And the second one is that they don't know everything, genuinely, because upward communication is so difficult. So this is why when I say you need to get out of the front end of the business, it's not I distrust the CEO and the execs. It's I'm keen to help them to understand what's going on at the front of the business. Because any CEO who begins to manipulate the agenda to their own benefit, if there's a strong chair of the board, that CEO is going to be toast, and it'd be P45 time. So I think the bigger issue is they can't possibly know everything that's going on. That's not humanly possible. Therefore, you're helping with that picture, and that's incredibly important.
Looking at the book, we've heard about the impetus for writing it, and that sort of epic conversation, which I think makes a great introduction. Can you talk a little bit about how did you go about researching this topic, and what did you what was your approach to kind of almost, if you like, answering the question that had implicitly been posed to you, which was, how the hell am I supposed to do this?
Well, I started off by thinking I needed to understand how things had gone wrong. So if I could find out what the pattern was of failure, then you're beginning to draw a picture of what success looks like. What I rapidly discovered was that it's public inquiries about failed organizations that give you masses of information. And the United States is fabulous at this because they have public inquiries going back decades and decades and decades. It's a more modern institution as far as I can tell in the UK. So I was able to look at the public inquiries for failed banks in the US and in the UK. I looked at a Royal Commission of a failed insurer in Australia. And then having sort of seen that insurers were failing for exactly the same reasons at board level that banks were, I thought, well, I better look outside the financial services. Where else can I go where there are public inquiries? And within the UK, the obvious answer was the National Health Service. So we've had several public inquiries. That, thankfully, these things don't go wrong very often. But when they do go wrong, what you discover is a hospital fails in Morecambe Bay or Bristol its staffs for the same reasons that banks failed in the US and an insurer failed in Australia. So you begin to see, actually, it doesn't matter which sector you're in, this is what causes the problems.
That's a really interesting sort of research angle, because clearly those things, they're not, there's no chance of whitewashing here, because this is a public inquiry. And so I will say no chance. There's always clearly risks of it happening. But generally,
yes,
the start point is but the general start point is we're trying to find out what happened, as opposed to it being some sort of internal document. So this is going to be, so this has the benefit of being published. So you can't sort of hide, and we've all seen what happens when governments try and hide reports. Suspicion increases, but generally speaking, these things are being published. So they're pretty well researched. They go into a lot of detail, and they're coming at it from the perspective of we can't let this happen again. Which is why we're interested in it, because we're interested in it from a legislative perspective. So it's a fascinating kind of treasure trove of audits where you've probably got the closest thing you're going to find to 100% transparency around the issues and people being a bit more engaged with the process, because it has this governmental support to it, which an internal investigation might not. So it's pretty rich, I guess, and fulsome in terms of looking into detail. Now, you can say they haven't necessarily investigated what they should have investigated, but at least the construct, back to those, is one that's trying to find out what happened so that we can, and deliberately so that we can learn lessons rather than just sticking with the apportioning blame thing. There's an attempt to solve a problem, and that's why you have these investigations.
Yes, that's right. And I mean, you can look outside why did this organisation fail, also to why did this tragedy happen? And this is very much in the crosshairs of your work in behavioural science terms. So if you look at things like the sinking of the Herald of Free Enterprise, the ferry that left Zeebrugge with the doors open and flooded itself before it got very far. You look at the Fukushima nuclear disaster, you will find from those public inquiries not only pointing at governance problems, but you're into the Professor James Reason territory, the Swiss cheese approach to risk management. So these slices of Swiss cheese, and you hope that none of the holes line up, because that's when the tragedy happens. But these public inquiries, when you say this to people, they go, God, that must be a really dry read. You cannot believe how interesting some of these things are if you have the time. I mean, and you've got to have the time sometimes, because these things can be absolutely enormous. But they do show up things like how whistleblowers are handled, the power of the chair over the CEO or the CEO over the chair. You take the Herald of Free Enterprise. There were 4 or 5 things that happened at the same time, which on their own would have been trivial, but because they all happened at the same time, were catastrophic. And that's not. I mean, I think you find that with 3 Mile Island in the US with the nuclear disaster there. So these inquiries are really rich sources for researchers, I believe, and I don't think necessarily enough has been made of them in the past.
And the thing I find interesting as well about your research is you were obviously prompted by looking at one sector that you knew really well. But it's those read-across lessons to other sectors that I think are really interesting, because, when I was referring to company failures and issues, I think everybody is aware, although memory does fade, as we've seen in the banking industry, everybody's generally aware of big things that have happened in their own industry. And you sort of, try and learn, we don't want to be the next one of those. But actually, there isn't this read-across piece that says, ultimately, human beings are human beings. And so if something has gone wrong in the automotive industry, there's potentially lessons there for the banking industry, or for the health industry, whatever, is that read across that you've done where you cover those different pieces. There's a commonality of themes. And I think often we don't look at other industries for lessons that we can learn about the one that we're in. Yeah,
no, that's true. I mean, in terms of the work that I'd done for the regulator, there are, the building society sector, the banking sector, retail banking, I know it really well. So helping with work in those sectors, the supervisors, is quite easy. It's far more difficult for me in those sectors. So we'll take investment banking, which is your background. I don't really truly understand all the risks in investment bank, certainly not in the trading part of investment bank. However, if you ask me to do a governance review of any sector that's supervised by the regulator, it's not a problem, because the same dynamics apply whether you're the board of an investment bank, an asset manager, credit union, whatever it might be, charity even, it's exactly the same. So you're right, the read across is astonishing, to be honest.
And I think it's almost those basic questions that you distill down as a sort of, how do you know what's going on? And how are you getting your...
Yeah.
So there are some basic fundamental principles where you'd say actually, and to your point around, the reason you can have non-execs who don't have experience in that industry is that actually a lot of this thing is really getting to a basic level of understanding to sort of say, well, how do we know what's going on in the organization? How do we know what risks we're running? How have we got a temperature as to what's going on? All of those things equally applicable, regardless of which space you're in.
Yes. I think, I say in the book that I think there are 3 competencies a non-exec needs, including the chair. You need the skill, the will, and the knowledge. And this is to challenge. So you need the will to challenge. And some people just don't want to. They'd just rather keep their heads down. You need the skill to challenge, because what you want is, if you have to challenge, it's taken in the right way. You don't upset somebody. And you need the knowledge. And this is why you need a couple of bankers on a bank board and a couple of aerospace people on the BA, the British Aerospace Board, or whatever it might be. You need to have some sector knowledge. You don't want a pharmaceutical company with nobody with any chemical or pharmaceutical knowledge or drug development knowledge on the board. You need something there. So you need this skill, you need this will, and you need this knowledge. And that's largely agnostic across all sectors. It's just the knowledge bit that's specific. But it is difficult. I mean, if you're going to challenge, it's not going to happen if the chair isn't going to support challenge. And that's one of the dynamics. If you've got a very strong-willed CEO and you've got a chair who will not support challenge, you're on a slippery slope. Because then the rest of the non-execs are not going to get any support from the chair if they challenge the CEO. And in the end, the good ones will leave and you'll be left with the ones that don't want to make a challenge. And you've kind of handed everything over into the hands of this CEO, which is not to say that strong CEOs are not good. Of course they are. And by definition, you're going to be. But to get the best out of a strong CEO, you need a strong chair, so that the strong CEO's wonderful ideas are capable of being challenged and improved by the non-execs. That's a really core dynamic. And I'm not going to name the institutions that I could name that have had a weak chair and a strong CEO, because I don't particularly feel like being sued. But it is the truth. And there have been too many of those kind of failures. It's not always seen. And I think if the non-exec chair doesn't have the knowledge of the sector, or can't draw on 1 or 2 non-execs who have got knowledge of the chair of the sector, then you do have an issue. You've got an issue around how well you can challenge.
And one of the things I sort of think is interesting as we look at the skills that you need. I mean, what screams at me there is you clearly need diversity on these non-exec boards. So you need the people, as you say, there's the people with the skills, the different perspectives as well. And of course, if you look around many of the boardrooms, there is, let's just look at visual diversity, but we can consider some of the other points. The photographs don't look particularly diverse, and the backgrounds are often not particularly diverse. And so there is an interesting thing where you often get sort of lots of people sitting on lots of boards, and so they kind of meet in different forms. So it is a little bit, in some cases, quite a closed circuit. And I'm struck by the fact that if we want to solve that problem, we have to let some other people in. But it's a little bit like the old acting adage where you can't get a union card until you've been an actor, and you can't be an actor until you've got a union card. So it's that sort of, how do we break that cycle?
That's an interesting one. I think it's beginning to be broken, because what's beginning to happen is I think that people are becoming non-execs earlier in their career lifetime than they used to. So it used to be people of a certain age, such as me, would start to become a non-exec. Whereas it's now happening 10 to 12 years younger than that. And people are making a proper career out of having 2 or 3 non-exec roles. So there's that side of it. But I think you point to one other thing we've not mentioned, and the regulator has had to step in and fix this as far as banks and insurers are concerned, the number of non-exec roles that you can hold. Because some people have been holding 12 and 13 and 14, and it's not humanly possible to do the job properly.
Well, that might explain the answer to that might explain that conversation that prompted your book. Because if you are sitting on that many, it possibly isn't reasonable for you to even read the board papers, let alone the detail beneath that.
No. Yeah, I mean, and unfortunately, board papers can come in multiple hundreds of pages. And this, again, is another... I mean, if you talk to any non-exec about what's the bane of their lives, they would probably say the board pack. and the risk pack and the audit pack because they're so voluminous. And it doesn't matter what the sector is, you seem to hear the same thing. And being able to write briefly and get the point over. And what you often get is an executive paper that's recycled for the non-execs. Whereas what you want is an executive paper rewritten for non-execs because they don't need all of the detail. They need the essence to know whether they need to call for more detail. But that's a bit of a challenge. I think it's an absolutely fascinating role, and I take my hat off to everybody who's doing it because most people do it really, really diligently and work really hard at this. But it's the odd one that we see that doesn't, that causes all the problems.
And it's as you say, I'm fascinated by the idea. I use words you didn't use, but the principle's there. It's a retirement home for many people. It's kind of like, what am I going to do now? I'll go and become and it's sort of, and I'm sure there were a lot of people cashing some quite big checks there because, my time has come and I will enter this, whether or not they were suited to the role. And the sort of people I'm talking about. But it struck me that, as you talk about people getting younger, one of the things that's really interesting is I think we're starting to see with some of the dynamics that are in companies now, and I mean dynamics such as technology, social change, and needing to respond to things like climate change. So a whole host of issues that possibly senior people within organizations haven't grappled with. So I always use the simple example of if you look at a bank, you could have been somebody that grew up with where banking was a physical building that you were in, and you control the physical work, and you could see what your workforce were doing because they were doing it in front of you. And what you're now in charge of is potentially a digitally led business that's global with remote workforces and a whole host of products that you're not necessarily specialist in. And if I take that example and think about some of the other issues and risks that businesses are facing, the social changes, the technological changes, you might find yourself running something that you possibly don't have quite reasonably haven't got experience of. So how can you get that experience to deliver that thing? So, it occurs to me there's a piece where actually experience doesn't necessarily equip you to deal with all the challenges. And we use it as he's been in the industry for 50 years, must know what he's doing or she's doing. Actually, that's not necessarily true with some of these dynamics. So how could you get that? Well, the answer is bringing some of your younger people in. So getting your workforce to help you think about some of these issues and bringing in people with potentially less experience, but who might be able to bring less experience of what you've got experience of, but a fresh perspective of things. So that leads me to two things. One is to sort of the diversity and trying to attract different sorts of people in to give you those different perspectives. But the second thing is looking internally for some of the knowledge that might be there. So I always think graduates, one tends to look at and say, well, they don't know much. But actually, they will know a lot about social media, about social trends, about views on climate change, where the world might go. And so I'm interested in your thoughts about how one taps into some of these things that you won't necessarily have the expertise of knowing about, just not through no fault of your own, because of the fact that you've grown up through a different world and have a different perspective.
Well, okay, I think there's a couple of things in there. Funnily enough, I was talking to a manufacturing company this morning, and they were telling me what they've done with their graduate intake. So normally apprentices rather than graduates, their apprentice intake would normally come in and be working on the job and be supervised on the job. Well, of course, they can't at the moment because they're all furloughed. But what they are is a business-to-business organisation. And all the research shows you that digitisation is very important to the customers of B2Bs, very important. So what they've done is they set a project up with these apprentices and with a couple of senior managers and said, we're going to show you how this business works, through video conference, and we want to start talking about how do we digitize it. So they've done exactly what you've spoken about, which is to use the apprentices to do this. And also some of the apprentice years 1 and 2 are also being used for this. I think there is always going to be a generation gap. And we are working longer. So I have to say that I know some fantastic non-execs, and I'm old enough, but are a good 10 years older than me. So yes, you might call it a retirement home, and perhaps it is, but they are providing just as good an asset. They are just as good an asset to the organisation as somebody who might be 20 years younger than them. I think that older generation of the company, it doesn't matter whether it's now or in the 1960s or 40s or 20s or 10s, they're always going to be a generation behind the young people. So the young people are always going to think, well, the world has changed. What do they know about it? Right. And if we fast forward to a time when I've turned my toes up and you are now a non-exec, you're going to have a younger generation think, what the hell does Christian know about it? I mean, for God's sake.
That's a valid comment at any stage of my life, John.
But I mean, it's the old joke, isn't it? Are you any good with technology? Short answer, no. My mouse is still in its cellophane wrapper. The older generation will always have less of a grip on the new stuff, but it doesn't mean that they haven't seen it all before, because the new generation is going to make exactly the same mistakes that the older generation have made in their time. And that's what you're trying to communicate across all the time. Stop people making the mistakes I made.
That's a really interesting point, actually, and there's as you rightly say, right. So the flip side to we're ignoring the kids is let's get rid of these people at the back. It's almost you see organisations throwing out people with decades of experience rather than thinking creatively about how can I engage that person, and actually so sort of saying maybe this person doesn't want to work 5 days a week. I know you don't just have to put them on the board, but I think there's tremendous. As you say, there's tremendous value for someone that's been around the block a few times, because actually, as you say, the sorts of mistakes that have been made. And I think there's something tragic there about the value of human capital, where we exclude categories of people for some arbitrary reason, and we don't think what knowledge we can tap from that. And I think that's a really interesting bit. As we, one of the key things that strikes me is we need to get more out of human capital. And I don't mean from an exploitation perspective. I literally mean to solve the business problems and challenges we have nowadays requires all of our people to be working at their A game. And let's assume I've hired the smartest and the best people I possibly can, which is what everybody claims they do. Then we want to get the most out of those people. So why are we not thinking in those terms? And it sort of strikes me that actually what you've looked at from this construct of non-execs and how they can be powerful, that's a lesson for actually looking at the business as a whole. And are we getting, do we have the right sort of inputs at the right places? Are we tapping the right sort of knowledge? And particularly where some of the solutions, and we're seeing it now with COVID, there isn't you can't just follow what we're seeing with government restrictions on this stuff. You need, even a well-designed plan is going to need to react to things. So we need to have quite fluid, flexible structures where there'll be knowledge somewhere in the organization that could be useful, and how do we tap it? So what you've talked about for the non-exec piece could equally apply to how you run the business itself.
Yeah. It can do. I mean, you always have this debate around the board as to whether one of the non-execs should be, an IT specialist. Well, there's two problems with that. Is which bit of IT? So what we're talking about, networks, mainframes, telecoms, cyber, what we're talking about? Because this is a huge industry, IT, obviously. And the second thing is, if there's one person on the board who is that specialist, as soon as IT comes on the agenda, all the other non-execs sort of gently nod off because they know it's taken care of. And I guess there's just a worry as well, if you bring any specialist on, IT or any other specialist, that they have a broad enough knowledge to be able to contribute to the strategic development of the business. So it's probably better that the board decides, actually, we need to have a better knowledge of IT and some good advice. So we're going to set up an IT advisory group of the sort of people you're talking about, who are senior people, have been around, willing to put in a few days a year. And this group comes together, looks at what the organization's doing, is able to engage with the non-execs and talk to them about what they should be thinking about. That I think is exactly where you should be going. And we've picked on IT as an example. But I mean, risk management has got to be another one, given what we just come through for the last 6 months. In terms of risk management, by the way, I'd come across a black swan. Have you come across a grey rhino?
Yes. Michelle Wooker.
I hadn't. So this is the risk that's a high impact, low probability. We all know about it, but we've done nothing whatsoever to plan for it. And that, of course, was COVID. So COVID wasn't a black swan. It was we just weren't planned and ready with a playbook for a pandemic. Or it appears that we weren't often enough ready with a playbook.
Yeah, there's a lesson there as well, which is if you're going to talk about this, you need an animal. Right, so we sort of. I thought her. I absolutely love the branding because it's brilliant. It follows through from Nassim Taleb. It takes the concept of elephant in the room. So we all seem to love a good animal analogy, and they're running out slowly but surely, John. So we need to grab one now while we can.
Yeah, that's right. Yeah, well, Andy Haldane talked about chicken licking last week, so the chicken's now in the. We don't want to keep talking the economy down like chicken licking, I think is what he said. So, we're running out. Turkey's another good one. There's plenty of turkeys around.
Look, I guess to sort of close us out, you've presented a set of challenges, sort of how business ought to do stuff. I mean, what if a listener is in a company and they have the ability to influence these things, where they recognise the dynamics you're talking about, and sort of say, we haven't got that level of senior challenge. What's the one thing that companies should really be focusing on to get this stuff right? Not to say the other things aren't important, but what would your sort of top tip be?
Well, I think the most important relationship in the business is the relationship between the chair and the CEO. And if that isn't working, you've not got much of a chance of anything else working in a kind of a cultural context. Because if one or the other is just too powerful, you don't want a powerful chair that overrules the CEO, and you don't want a weak chair that can't stand up to the CEO. So I think that relationship is one that's that's vital, and I think most senior chairs and most chairs of any experience will relate to that. I think I'd rather just suggest one thing to all of your listeners. If they're thinking that one day I'd like to be a non-exec, as time rolls on, there's a way in early, which I think is really useful. It might sound a bit strange, but the governor of a school is a non-exec. So if you get the chance to be the governor of a school, you begin to appreciate what it's like to play this role for the head teacher of the school. And also there are loads of local charities. I was a trustee for 6 years of our local hospice, and it was a fantastic experience because a trustee is a non-exec. So even in the earlier years of your career, you'll find opportunities locally to try your hand at being a non-exec and find out whether you feel you can make the adjustment to not being the exec and telling everybody what to do, and bringing a different perspective in, particularly, things like school or a hospice. I know nothing about either. And yet I brought that knowledge back out when I moved on to be a non-exec. So there's ways into this.
Fascinating stuff. Now, remind us what the book's called and where we can find it. I'll put links in the show notes.
It's called Ensuring General Wisdom, and you can get it on Amazon and from all good bookstores, as they say. There's a Kindle version and there's a paperback version. Thank you, Christian.
Fabulous stuff. And there's also some lectures that you've put online, and we'll put links to those in the show notes for people interested in following those up. But John, firstly, thank you for I'm glad you had that conversation that started the book, because I think you've exposed some fascinating stuff. And the bit I love about it is it's one of those serendipitous moments that we need in life at the moment, which is a small conversation can spark a book and research. So thank you for doing that. Thank you for also being great company on the podcast. It's been an absolute pleasure.
Well, I've enjoyed it. I love your podcast, so I'm deeply proud to now have been the subject of one. It's like Desert Island Discs for me, this is.
I won't ask you what you're taking on Desert Island, but I'll just say thank you very much.
Cheers, Christian.
So that's it for another episode of the Human Risk Podcast. My massive thanks to John for appearing, and to you for listening. To find out more about John, his book, Ensuring General Wisdom, and some of the lectures that he's done, plus some of the other things we discussed on the show, have a look in the show notes. If you're new to the Human Risk Podcast, welcome. You can subscribe wherever you get your quality audio content. It's available on all of the podcasting platforms. I'll be back very soon with another episode of the Human Risk Podcast. In the meantime, do check out the Human Risk newsletter if you're not already a subscriber. Link again to that in the show notes. And I'll see you very soon for another episode of the Human Risk Podcast. Thanks for listening.